valuation, right? Now, if there is a price round before that maturity date, then the valuation is at whatever price is set by the investor that's leading that round, right? So if here's the upside or the good thing about notes, potentially good thing about notes for investors is that if I have a 5 million cap and the valuation is set at 10 million, then I pay a price of 5 million for those shares as opposed to 10 million. So I'm kind of winning, right? But it's a privilege that I get for taking the risk early. And then the other thing is I'll get to you in a second. The other thing is you have a 25% discount. So it's either or. It's whichever is lower. So if if it is a $10 million valuation that's set, and it's 20, I can either choose between taking 75 price at 75% of that, or I can take the 5 million. Obviously, 5 is lower than 7.5, so I'm gonna take 5, right? And then it's a note. It's a debt instrument, so there's interest that's accumulated every year. You had a question, right?
So initially, the value of the company is based on what investments you've gotten, or what? You kind of lost your time. I'm sorry.
I was saying initially, the value of your company is based on what investments you've got, or
so
how does that work?
So your question is how's the valuation set, right? It's kind of ambiguous actually. It can be, an entrepreneur feels that their company is worth this amount. From an investor's perspective, if there are tangible things like revenue, right, I'll look at that and then apply a multiple towards that revenue. So let's say other companies in the space are, let's call it trading at a 4x multiple, I would apply that 4x to that revenue number, and that's how I get my valuation. But then there are other things you got to consider too, like, is this a return founder? Has she sold a company before for a lot of money? Has she taken a company public before? It's the same team. You give them some credit for that, so the valuation starts to inch up, right? Is it a really new and hot space? Is this deal really competitive? Is Ryan over at K4 Capital trying to steal the deal from me, and I gotta outprice him or something like that, right? So a lot of things go into it, but generally you try to find markers and industry markers to help you figure it out. All right. So jumping into the model. I mean, if you can do division, you can create a cap table, right? That's all it is. So I'm just gonna try to walk you guys through this. Hopefully it's not too clumsy. All right. So we said that there were 10 million authorized shares. And each of the founders, so founder 1 and founder 2. Oh, you guys gotta put that back up. Okay. Sorry. So founder 1, founder 2. Both have 2.5 million shares each, right? Totaling down here 5 million shares. The valuation cap for the note was 5 million, so that's here. The importance of the valuation cap is it determines what I'm going to pay per share of stock, right? So, for instance, so basically what I'm going to look at is the number of shares that have been allocated, right? And I'm going to divide that. I'm going to divide the valuation by the number of shares that have been allocated, and that's how I get my price valuation per share, right? So it's just division. That's how I got to $1 here. Now that's just that's the common. I got an investor, actually 2 investors that put in 500K each. Dope VC and investor 1, right? Totaling 1 million, right? So now there's been $1 million invested into the company in the form of a convertible note. And the only other thing on this exercise that is really important to point out is, remember we talked about the purpose of having a cap table is to understand your ownership, right? How much of my company do I now own? So as the founders, with just that $1 million investment, combined, they own 83.3% of the company, right? Which is a great place to be when you're starting a company. I'm gonna ask some trigger questions. Yeah, so we talked about the cap and the discount. So let's move forward to exercise 2. Exercise 2 builds on exercise 1. So, you know, a year has passed and our company has done well, and someone, or your company has done well, I'm the investor, your company has done well, and so you're raising another round of funding to help you with growth, right? So what's gonna happen here? Your seed notes are gonna convert. They're gonna either convert at the 5 million cap or 25% or 75% of the valuation. The investor, the new investor, they're gonna price this thing, so they're gonna set a pre-money valuation of 13 million. Anybody know the difference between a pre-money and post-money? Pre-money, yeah, she got it. Pre-money is the price of the company, or what the company is valued at prior to the investment. And then the post-money is it's an addition of the valuation of the pre and the dollars that came in after, right? And so when you're talking about before the round is done, you talk about valuation in terms of pre-money. And then once the round has concluded, then you speak about it in terms of post-money.
I was actually going to ask that about the 5 million cap. Is that essentially post-money? Like, or how does that play out for
It's so there wasn't, right? Because it's not an equity round. It's basically debt at that point. The question was the 5 million cap considered post or pre? And it's neither, actually, because it's a convertible note. It's a debt instrument at that point. And while you're holding a note, you're not actually holding equity, and so there isn't a true valuation at that point.
I already know the answer, but for some of the entrepreneurs here, so what is the average interest rate when giving out a convertible note? Who sets that, the investor or the founder of the company?
Like everything involving the deal, everything's negotiable, right? So and it depends who has more power in the deal, but typically you'll have a lawyer, and that law firm would have seen some number of deals similar to this, and they'll say, hey, the average or the median interest rate is this, and so that's what they'll say, let's go with, right? And as an investor, you know, I'm thinking about it from a risk-reward standpoint, and I may go up and I may go down, and it's basically just another level for negotiation. Typically, if you're really bullish on the deal, the interest rate doesn't matter so much to you, right? There are other factors that are more important. So if the entrepreneur wants a lower interest rate, you're probably going to do that, right? And you know, if things go as they should, the interest that you're going to get over a year or a 2-year period is not going to really be material in terms of your ownership.
Can you hear me?
Yes, I can.
So what has been your experience with buy-sell agreements, and what role do they play in this discussion about ownership and valuation?
All right, we got to ream the questions in and keep them about this. I can catch up with you about that afterwards. Okay, so it's a 13 million pre-money. It's a $2 million round. There are 2 new investors. One is going to invest $1 million. The other one's going to invest $500,000. I'm going to follow on and do $500,000 in this round, and we're gonna ask for a 20% option pool, and we're going to do a pre-investment. So does anyone know what an option pool is? Go ahead. Yeah. So it's a percentage of the common stock in the company that you're holding to either reward employees for doing well, or you use it as a recruiting vehicle to hire, I don't know, your CTO, right? Because one of the carrots, or the main attractive things about joining a startup is the fact that it's going to grow and you'll have ownership within that startup. So this option pool allows you to basically award and reward your employees and soon-to-be employees with stock in the company. And so at the early stages, you want a pretty hefty option pool, so that you don't have to kind of create an option pool again and again and again, because as you increase that option pool, you become diluted, right? Because remember, it's price over shares, right? So once you start adding more shares, you lose ownership. I'm sorry, he back there.
So you actually just mentioned the word dilution. How do you think through, from a term sheet perspective, sort of who gets diluted when? Is it founders? Is it subsequent investors? How do you think through that?
Yeah. So one of the key things here is this pre-investment, right? So I want that option pool to be created before I put my money into this round. And the reason I'm doing that is because once that option pool is created, at whatever time that option pool is created, whoever owns stock in that company, they're going to earn less, right? So I want that to happen before I invest. And entrepreneurs might want that to happen after I invest. So again, it's another point where we start to negotiate. You had a question. He's wearing money.
The option pool being hefty, what do you mean by that? Like a 10%, or like what is?
Oh, it's going to vary. I think anywhere from 10 to 20% for a really early company is fair. Most of the times you'll probably get to 15 or 10% at this stage. Series A companies probably have an option pool around 10%. Because at Series A, you probably have your most of your key executives in place, which are the ones that are going to be awarded most of that option pool. So you can have a little bit less. But in this case, we're asking for 20, and so in this spreadsheet, basically what we're doing is we need to say, all right, of those 10 million authorized shares that we have, we need 20% of that to be in the option pool. So for those of you spreadsheet jockeys out there, basically you just run a goal seek, so that you set this cell here to equal basically 20% by changing the number here, right? So what happens is this number gets bigger, and you can see that my price per share gets smaller. So that's what we mean by dilution. Now in this Series A, all right, so we're putting in $500,000. These two investors are putting in 1.5 million total, which is 2 million. The pre-money valuation is 13 million, and the price per share is basically calculated by the pre-money valuation divided by the sum of the common stock plus the stock that was purchased in that note that's now converting into the equity. Everybody got that? All right. Now you can ask questions if you don't, but I'm assuming you got it.
Joe, can you repeat that, please?
Oh, sure, I'll repeat. So the price per share is calculated by taking the pre-money valuation, which we set at 13 million, and we're going to divide that by the sum of the total stock that has been issued in the company, right? So the common stock plus the stock that was purchased as a part of the convertible note. Because remember, the convertible note is converting into equity at the first price round, and that's where we are right now. I got it already? Yeah. All right, so now we actually have preferred stock in the company. I'll get you in a second. Now we actually have preferred stock in the company, right? Because we're investing in a price round Series A. So now I have, before I only had fully diluted ownership, right? Now I have preferred ownership and I have total ownership. Anyone know why this is important? Right here. It all comes back to control. It all comes back to control, right? So remember I said the difference between common stock and preferred stock is that preferred stock has more privileges, right? And they get to make certain decisions, right? Can you sell your company for $1? If I'm an investor and I bought in for $2, I'm going to say no, right? And the other investors are going to say that too. There's a concept of voting thresholds for the preferred stockholders, right? So I could say maybe it's majority. So if we want a decision to go forward, 50% of the preferred, or 50.1 or 50.0000001% of the preferred need to agree to move forward with whatever that measure is. So as you're thinking about your investors and who you're taking money from, this becomes really important. Because there are going to be some investors that you really align with, that you think are really good for your company. And there are going to be other investors that you're like, right? They're okay, but we need the money, so we let them in. And you just want to make sure that no one investor can make decisions about your company all by themselves, right? So in this case, Dope VC owns 38% of the preferred ownership, right? Which means that I would then need, let's see. So I would need it, in most cases, I would need at least 2 investors to agree with me, or at least one other investor to agree with me in order to move that money forward. And as an entrepreneur, that's something that you want to make sure. Now, you'll note that none of the founders don't have any preferred stock, right? And again, that's because founders get common stock and investors get preferred stock. But what's still important here is how much of the company the founders own. They got diluted now. Now they own combined 54.3% of the company. So something else you got to think about as you move closer and closer to exiting this company, right? You got to think about how much you're doing this for a reason, right? You're doing this because at the end of the day, I mean, you may be doing this for a social good, which is great, but at the end of the day, I think we build companies to generate wealth, and so your ownership is really important, and understanding, what you could get at the end of the road is really, really important. Yeah, question.
Can you talk a little bit about the impact of forfeitures or the expirations of option agreements to the cap table? How forfeit amounts are redistributed?
That's a little beyond the scope of this exercise, but I can talk to you about it offline afterwards. I feel like we'll get everybody lost.
I missed how the note shares convert. Like the actual 535 converts into 700K shares.
But general answer to your question, if let's say you awarded some number of shares to an employee and they have a vesting period. So that's another concept. So there's a vesting period. This means that you don't get all that stock at once, right? Which is really, really important because you want to incentivize your employees to stay and do a good job over a period of time. It's usually a 4-year period. So let's say this employee leaves at the 2-year mark. So 50% of the stock that they've been awarded essentially would have vested, so they own that. The other 50% would go back into the pool, which is the gist of your question, but I know you want to get deeper, so we can talk about it later. And, I'm sorry. Oh, right. So the note and how it converted, basically, I'll let you see the formula. So remember, we had 7% interest on the note, right? So and it's a year later. So our initial investment amount, which was $500,000, just multiplying that by 1.07, and that turns into this many shares. And again, the way that we're calculating those shares is we're either going to take the price per share or the price per share based on discount, right? Which one of these are we going to take as an investor? Price per share, right? Because we're paying less for it. And the way that this is calculated is basically you're taking the common stock, which is all that existed in the company, when we did the note, and you're putting that into the cap, right, which was $5 million. Got it? Okay. Yeah.
Hi, I'm not sure if you're actually going to cover it in the next section, but can you talk about the difference between cumulative preferred stock and non-cumulative preferred stock, and how that basically breaks down as far as like investor ownership and which one they prefer?
Yeah, we'll get to it towards the end. All right. So 3 and 4. I think we're running short on time. So the 3 and 4 we'll try to put together. So exercise 3, basically, we're going to do the next round of funding. It's a year later, Series B, 20 million pre-money. That's the valuation. It's a $10 million round. We got 2 new investors, each putting in $5 million, 2.2 million, and then all of the Series A investors are doing their pro rata. And for pro rata just means basically it's your ownership in the company before this round, and you're just basically multiplying that percentage. I can't hear you.
Can you zoom in?
Zoom in. Oh. Sure. Does that help? I can. I forgot where it was. Oh, pro rata. Right. So basically, you're multiplying your percentage ownership by however much is coming into the company. Right. So if I own, well, I'll just show you in the model. So here we go. So Series B, basically. Can you zoom in? I can. How's that? All right. So basically, my Series B amount, I'm going to calculate it by taking my fully diluted ownership in the company times the amount that's being raised in the round, right? So one of the terms in the term sheet or in the investment documents is you might have a right to invest at your pro rata, right? So what that does is it makes sure that I can maintain the same level of ownership in the next round of funding, which as an investor is really important to me because I don't like dilution, right? And I'm thinking about the carrot at the end of the trail, right? How much am I going to get out of this thing when it's all said and done? All right, so all of the other things are the same mechanics as before. Let's talk about exits. All right. So at exit, we're saying that the company is now doing 200 million in revenue, and this is 2 years after the Series B. The reason why the time matters is because we in venture capital and investing, the measure of success is IRR, which is a time-based metric. So it's not just the dollar amount, but it's how quickly did I return that dollar amount to my investors. So the fact that it's not 1 year later is really important. But so it's 2 years later, after the Series B. There were no investments after the Series B, which is also really important. The reason why that's important is because if I did not participate, I didn't invest in the Series B, then there's going to be some level of dilution. Because there was no round, and there was no round for me to invest in, there's no dilution for me to worry about. Yeah.
Pro rata rights. Do you have to put more money in as one of the original founders when the money is raised in the Series B?
Founders don't have pro rata rights.
Not founders, I'm sorry, the original investors.
Yeah, so that's what I was saying. If you have that privilege, if you have that right, then in order to maintain it, you have to invest whatever that number is in this round. If you don't, you lose it, generally speaking. 5 minutes? Okay. So just to wrap this up, and we're applying the exit multiple of 5. So exit multiple is basically created in the same, you get it basically looking at public companies and other private companies in the space, and you determine whatever that is. Maybe take the median of a bunch of public companies of their trailing 12-month revenue, and you apply it. So what we did here, really quickly, 2 million revenue at the time, and it's an exit multiple of 5. So the exit valuation is basically $1 billion, and then our take of that is whatever our fully diluted ownership was at that time times that $1 billion, which gives us basically 109 million. And then to calculate IRR, you can create you guys have the table, but basically create a table similar to this, which basically here captures your outflows, so what I invested as negative numbers, and then ultimately what I'm going to get back. And the formula here is basically just an X IRR on the exit number, and that's how you get to the end. Only other thing that you guys should want to consider here is the concept of liquidation preference. And so liquidation preference comes into account at the very end, right? The standard these days is 1x liquidation preference. So what that means is, remember I said that preferred has certain privileges that common doesn't. One of those privileges is that we get paid before you, the entrepreneur that's doing all the work, gets paid, because we put up the money. It's fair. And so 1x means that as soon as we get our ownership, whatever our percentage is of that return, then the common holders start to get their returns, right? Now, if you do something like a 2x liquidation preference, now you're getting into a place where the investors is getting a little bit more than maybe what some say, maybe more than what they deserve, but it depends on the situation when the deal was done. So now, once we get to 1x, right, now everyone starts participating, and including us. So we're continuing to, so right alongside you, I'm taking more cash in until I get to 2 times my ownership in the company. So a lot of people think this is unfair to entrepreneurs, a little founder unfriendly. So typically it's 1x. But really important for you to note, and something critical for you to think about as you're thinking through and negotiating terms. And I think we are out of time, but I could probably take one or two questions.
The gentleman behind me wanted to know if the slides were available somewhere, or do you have a course that you teach?
Yes, so in a few places. So HBCU VC, so my interns, they have an online course, and I provided some of the content for that, so you can find it there. Also, this specific PowerPoint presentation and the Excel document, I think, have been sent to everyone through Blavity and Afrotech. They didn't send one with the answers, but I'm sure they'll do that right after this session.
Thanks a lot.
All All right, thank you.